All right, hello, everyone. Welcome to today's weekly market check-in with myself. I'm Greta Wall, your host, and I'm joined by Derrick Oldensmith, the professional trader with T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Real quickly, before we get into any market discussions, here's a look at the current positions Derrick is holding and trading. You see lots of longs there, along with the green market here. I think kind of 24 longs today, Derrick. So how's your Monday going? How are you feeling about this market?
Yeah, not bad at all. Getting a little further continuation to the upside in the market, which is exactly what I've been looking for. We're now into the 21 EMA for the S&P. We're actually above it for the S&P. We're into it for the NASDAQ. I do think that there is some room for us to be able to push up further here. I think still in the SPYs and move up to 580, 582 is conceivable. So there's still some upside out there. But at this point, I'm more into paring down some of my long exposure, booking profit into this up move, and at a certain point beginning to maybe consider shorting a little bit just to get myself a little bit more market neutral as we work our way higher towards the upper band of the bigger picture target that I had back a week plus ago when the market was still making new lows at SPY 550. So far, so good today.
All right, so you and I have talked the past 2 weeks. You were definitely more long than the overall market condition throughout the past 2 weeks. Got a little bit of a struggle with some of those longs, I'm sure. So maybe a little bit early, but you were definitely expecting this to come. Of course, you weren't expecting the news of Trump saying, the tariffs may be more flexible on those reciprocal tariffs, but that definitely helped. What were the signals, though, you were seeing in the market, before that made you flip long and look for this follow through on this kind of move?
Sure. So we're definitely getting some follow through to the upside on a little bit of relief from the tariff language that came out of the administration. I mean, this has just been very, very simple. Every time they mention an increase in tariffs, the market goes down. Every time they mention a decrease in tariffs, the market goes up. I mean, literally right as we were starting our conversation, an announcement came from Trump about implementing tariffs on cars and pharma. And we instantly see a small but notable downtick in the S&P, the NASDAQ, and they're also pretty much on the spot. I mean, it's just clear as day. Literally every single time there's any language on tariffs being reduced, we go higher. Any language on tariffs being implemented, we go lower. The market just keeps showing it to us over and over and over again. But positioning and market dynamics are still just such a huge, important part about this market. And when we were making lows, I can do a little bit of a screen share here if you want me to turn that on.
Yeah, definitely.
Should be good.
There we go.
So when we were making lows down here, and I started a little bit early, I started a couple of days before that on getting out of my shorts and getting into my longs, even though I really didn't expect the bounce to occur until at least March 14th, which is when the flows typically change. We had hit so much downside extension on the 10th that I felt I could jump the gun a little bit and just start getting long just because there's a chance that we could just have an extension oversold bounce back before the flows turn positive, in which case then I missed more of the low. And it's not what happened. We stayed incredibly weak here for a few days. And then lo and behold, March 14th, that is the exact date when historically inflows begin to return to the market. We started to catch our first real bounce, and we've created more of a real low. Now we have a little bit of a higher low that came in on the 18th. On Friday, we held in great as well. On Friday morning, I was telling the team into the gap down that this is a gap down that we should be buying, because while the upside might be limited, there should at a minimum be a floor to this market right now. And again, it's just based on flow and market dynamics. Anyone who was going to sell in the short run pretty much did into this down move at that point. So all the data that I'm looking at this point just shows that there's been a huge positioning unwind. Some of the systematic funds are actually fully short this market. And for the most part, there's only one real way that it can go, which is buying coming in, or at least the selling gets abated. At a minimum, I thought we would see some sort of a floor here. So that gap down on Friday was very viable. It's also notable when you get a gap down like that and they buy it right back up to green to the close that we could see some upside follow through. And then that's exactly what happened today. Obviously, it's being positively impacted by just an update in headlines that maybe these tariffs aren't going to be quite as bad as was originally being stated. But this upside follow through is no surprise. The question is, where can we get to, and then what does that lead to? So I actually think that the buy dynamics toward this market should be turning incrementally positive as this week continues and possibly through the beginning of April. And then at that point, we can assess whether or not this is just a bigger picture oversold bounce, which is what I was originally looking for, that then gives way to lows, or if it actually turns into something bigger. I'm not ready yet to make that call. I want to take this one step at a time for the moment. I want to see if we can get to the upper band of my target. If you remember, back here on lows on March 13th, I was saying it's a wide range, but 570 to 582, I think, is very possible on a bounce back for the market. We went sideways enough here where this 21 EMA caught up, which I think actually can limit the reward a little bit. But I still think that there's a possibility that we overshoot this 21 EMA, get us into these low 580s, get anyone who is trying to immediately jump back into this market short because sentiment's gotten so bearish, push them out, cause them a lot of pain, and then we can assess whether or not we get a genuine pivot high that leads to downside continuation, or if we actually begin to get more information that leads to a reversal. But bottom line, as we get to this price point here, as we get to this declining 21 EMA, I'm becoming more interested in just selling out those really good long positions that I put on, taking risk off, and then putting that money in my pocket, and then reassessing how I want to position myself as we continue higher.
All right, so you say you're looking to possibly start getting on the short side to get yourself a little bit more neutral in this market. What are some of the names you're looking at for that type of trade?
Sure. So what we're seeing right now, and this is also what I expected, is that the crappiest, most expensive stocks are the ones that are really leading this bounce back higher, especially today. So you can look at Tesla as an example of a really crappy stock. It's up 10% today. It's really leading this bounce back. I was just saying last week, Tesla could easily give a bounce back to 280. I still think so. And if this thing gets into the 280 to $300 area, I have a very small short on right now, but it's really just meant to be a day trade. And I've already covered a bunch of it from when I put it on. But any bigger picture short in Tesla, I want to be looking, I know it's a wide range, but somewhere between 280, 300, maybe even a little bit of an overshoot of 300 as the market's getting into the area where I think it can find some resistance. Then this would be a stock that I would look to short. Or Palantir, another example of one of the most expensive stocks in the market, trading up 5% today. Really, really strong. This one I already did start a short in, and I know that I started that short early, but I actually don't mind because I've just got so much long exposure on that even though I am piecing out of that long exposure on the way up, just in case I'm wrong and we don't really get a move all the way to like 580 or so in the SPYs, which is where I'll just continue to de-risk. In case I'm wrong, at least I've got some Palantir on my books to the short side. If we pull back, that'll cushion a little bit of the giving of P&L back of the long exposure that I actually have should the market not reach my upside target and actually begin to work its way down earlier than I expect. But admittedly, I'm a little bit early on that. If I was more like flat portfolio-wise, if I didn't have any longs on, I probably would be looking to wait until upper 90s to low 100s to actually reestablish a short in Palantir. Let everything just boost its way higher, let these crappy names continue to lead higher, and then that's something that I would short. At some point, I'll start looking at this MSTR again as a short. There's resistance up here at 340, but Bitcoin basically trades as like high beta NASDAQ. If the NASDAQ is up, then Bitcoin's going to tend to be up as a higher percentage than the Qs are. And if the NASDAQ is down, then Bitcoin is going to trade down even more. So if there's still some possibility of market upside, which is what I'm expecting, I don't want to jump into this too early. But MSTR, this thing can get, I don't know, somewhere in the 340 to 380 range. I know, again, it's a very, very wide range. I'll narrow that range down as I see it trade into those prices. And as I see the market, again, reach more of these upside targets. That would be another one that I would continue, I would consider shorting. So, again, basically we're seeing the most beaten up crappy names give the biggest bounce backs today, those are the ones that eventually I would go after for a short, but I'm not ready to kind of jump in front of that train too early for some of these names and get totally blown out.
Do you have any thoughts on NVIDIA after the GTC conference last week? I mean, the market was kind of meh about the response because, yes, they're an amazing company and they're saying all these things, but you already knew all these things. There was nothing really new when it came to come from NVIDIA. So what are your thoughts on the stock here?
I don't have anything new resulting specifically from that conference. I do think that the chart looks good. So this thing started showing relative strength into this bounce back well ahead of the Qs. NVIDIA started bouncing back and bouncing back more powerful than the Qs were able to into this initial move. And then if you just continue to compare and contrast that chart, this is a beautiful looking higher low here with some support that they found around 115 in NVIDIA. 120 became a little bit of a level. Today they're breaking above that 120. 122.50 is also important. So I think that NVIDIA looks pretty decent just from a relative strength perspective. So if this market can continue higher, if we can get to, again, SPY 580, which I think would coincide with QQQ 495 to 500, I think that NVIDIA will continue to be one of the leaders in that bounce back. The real interesting one to me more recently, though, actually has been AMD. AMD just left for dead, absolutely destroyed and beaten up stock. This thing put in an all-time high back in March of 2024, so exactly a year ago now, almost $230, like $227, just to get absolutely cratered. This downtrend that this thing has been in since October has been relatively weak. It's been brutal. You can just very, very clearly see these pivot highs coinciding along a nice downtrend. And then I started to call out to the team and take notice of this thing was actually starting to act a little bit better underneath $100. It established some resistance of a range, like the range was support 95, resistance 102. When it broke above that 102, it started showing relative strength. I was like, oh, this is interesting. And maybe this actually is going to be a catalyst now that leads to the break of this downward channel. And lo and behold, you fast forward here a few days, stock held in great in this consolidation. It was relatively strong in the tiny market pullbacks that we had last week. And then you're getting just beautiful upside continuation in AMD. It's up 7% today. You could also make an argument that this is also in some ways similar. I would also argue it's different, but in some ways similar to like a Palantir or a Tesla, where it's one of the most beaten up major companies that's out there that's giving one of the biggest bounces today. I would argue that AMD has significantly more appropriate fundamentals compared to Tesla or Palantir. But really loving how that chart looks for continuation. It's a bit too extended, I think, for anyone who's flat it right now to buy here at 114. But the AMD story hasn't been chatted about in a while. All everyone is doing is talking about NVIDIA. And again, I like NVIDIA's relative strength here compared to the Qs. I think it can go higher. But the AMD chart is of particular interest to me that it finally broke this massive downtrend that it's been in for a while. And I do have a long position in that.
All right, AMD, the chip maker in focus for Derrick. All right, you've mentioned Tesla. I want to get your thoughts on the move. And I mean, Tesla obviously in the news, in focus constantly with Musk being the leader of Doge and being so involved in the Trump administration. You know, some other traders I've spoken to, you know, said all of the hate and all of the stuff on social media against Tesla cars and all of that stuff was really at that point kind of a buy signal for them that there was going to be at least a bounce in the name, and definitely more than just a bounce that we're seeing at this point. So what is your read on how Tesla has bounced?
Sure. So I am a Tesla bear, but I have also really been looking for a big bounce to come into the stock. It's just the nature of the way that this type of name trades, a name that's got a big story behind it with a big personality CEO that trades at a very high multiple is going to be the type of stock that gives you really big bounce backs. If anything, my surprise on Tesla is that we haven't had a larger bounce back in the stock sooner. I thought that we would get a bigger bounce back somewhere along the way from this move lower. So last time I called out a short in Tesla was on this bounce back into these mid 360s. We traded straight down from $367 to $220 with zero bounce back at all. Obviously, That's partially due to the market because the market was getting destroyed basically at the exact same time. But that's just the nature of this name. Whether it ends back up at $450 or it ends down at $150, you're going to see big moves in both directions, no matter what, as it plays out on its really big picture. For me, I'm still looking at a stock that's trading at 134 PE with growth that has slowed down to 1%, with a brand that's absolutely imploding. There's no one in Europe that are buying their cars. EV sales overall in Europe are going higher. And at the same time as that, Tesla sales specifically are going lower. They're losing that market. They're also losing the Chinese market. They can't compete in China compared to Chinese EVs that are proving to have better technology. And look, in the same way that in the United States, we try to have a concept of buy American and be patriotic. You think other countries don't have the same thought process? You think that if you live in, Germany, you don't think, let's buy German, let's be patriotic. Or if you live in China, let's buy Chinese, let's be patriotic. So why is Tesla going to win in China when their tech is starting to prove that it's not even as good as those Chinese cars are? And Chinese people most likely would rather buy a Chinese car than buy a US Tesla automobile. So they're losing in the European market. They're losing in the Chinese market. I think that they've completely destroyed their brand in the US market. I keep saying this over and over and over again. I'm not trying to make this as a political statement, but to me, it seems very obvious. Just ask your friends. People who you are friends with who are on the left are not going to buy a Tesla car because of everything that's been ongoing with Elon Musk. People who are on the right are not going to buy an electric vehicle because they don't like the concept of electric vehicles. They want American muscle. They want gasoline in their engine. So I just don't know. I don't know who is going to be buying Teslas. You see it in their growth numbers, which are absolutely imploding. And it's still an extremely expensive stock. Now, the counter argument that I think someone could attempt to make is that it's the same argument that they've made forever, which is that this is not a car company, and that you have to be thinking not just about what I just described about the car situation imploding, but you got to think about everything else that's ongoing. You got to think about AI, you got to think about robotics, you got to think about driverless vehicles and driverless vehicle technology and how that is going to work its way into the US market over time. I just think that that's a huge gamble at this price when they don't actually show any leadership in those areas. I don't think that I think it's too early to call on robotics. Maybe they come out as a big leader. Maybe they don't. There's going to be a lot of competition as they're ramping up. But I don't think that they're winning on the AI front, and I don't think that they're really winning on the driverless car front. I think that Uber is the railroad track, and Waymo is the railroad car that goes on Uber, and the partnership that they have is looking to me like it's actually going to be the winner in that space. So for sure, it's a story stock, and if they can hype that part of that story up and it can come together, then yeah, maybe this thing becomes a $1,000 stock again at some point. It's just not what I see happening from a CEO who is just extremely, extremely distracted. And I hope that, some of the efficiencies that they're working on with Doge, like getting rid of corruption, I genuinely hope that getting rid of any corruption that exists that can save the taxpayer dollar works. But you can't argue that from just the shareholder perspective, that it just creates a more distracted CEO who can't actually focus on his company. He's already managing like 10 different companies, which, as I say that, one final note, could also be a bull case. That at a certain point, if Tesla were to go to, I don't know, $100, where maybe it trades at a little bit more of an appropriate PE, Elon could potentially merge companies together. There's a lot of value in Starlink. There's a lot of value in SpaceX. There's a lot of value in some of the other companies that he has. And if he were to, at some point, merge those companies together, that's always a back of the hat straw that can be pulled to save this company if it fails and continues to implode. But this is not one that I have any interest in buying for more than an oversold bounce. I called out the long literally last week, even though I didn't take it myself through 240 for a move back to at least 280. Bam, 2 days later, we're almost there at that 280. Between 280 and 300, I become more and more bearish if I can get a signal to actually put that short on, and the market's giving me the confirmation as well.
And, you know, the story with Tesla is the future and the pie in the sky stuff, but the real numbers of the right now, we'll get delivery numbers next week on the cars for Q1, and they're not expected to be great. So we'll see. We'll see if the stock can continue this run. All right, we have a question from YouTube. Apex Joy wants to know your view on APP, AppLovin, and MU Micron.
Sure. So Micron's in the penalty box from that earnings report. I just wouldn't touch this. This reported earnings on Friday. There it is. This reported earnings on Friday. Market didn't like it. Market didn't treat it well. And on top of that, it's just been stuck. This name has been very out of play for a while. It's been stuck in this huge range between 85 and like 110 on the upside. So into that 110 area, it's been consistently shortable. Into that 85 area, it's been consistently viable. In the midpoint, after an earnings report that the market didn't like, I want absolutely nothing to do with this stock. I don't see an edge in trading this right now. We need to wait for it to break through that support or break through that resistance to actually be able to get more clarity and to see what happens next. APP is one of the names that I do like for a bounce back. I called this out for a long for the team last week, even though it's another one I didn't take. I just had too many longs on my plate. Can't buy them all. But this is another one that I like for upside continuation. This is just my same thought process basically as I have with the market. While the market is still within its ability to give a bounce back, this is the type of stock that I think actually should give you the most bang for your buck. These growthy type of expensive names can give you a big bounce back. This is not a name that I would want to be in for longer than a small swing trade, to be honest. And I'm not a huge follower on the story, to be honest, of this name. I know it's given an incredible move, but it did get hit with a couple short reports in here on the way down. So if I was someone who was going to be long the stock, which I'm currently not, I would certainly be making sure that I do some research to know what the bear thesis is of the short reports that help to hammer this stock down. But, you know, a snapback, again, it's a little bit late to buy it now. If you haven't from when I called it out last week, a snapback to 350 where there's some gap resistance, or even through the gap to 375, I think is very reasonable as long as this market continues this oversold bounce, which is still my baseline expectation for the moment.
Sorry, it's muted. Another question from YouTube, from AV. What's your thoughts on Amazon?
Sure. Sorry, just
trading everyone.
Pumping some trades in real quick. So Amazon, I also really like. This is one that I was buying and was long. I'm out of it now. I just had to have a more conservative game plan because, again, just so many long positions and so many long exposure. I have to make sure that I am being appropriate with my risk management in case I'm wrong, because I am wrong all the time. Anyone who's been in this business for as long as I have will have experiences of being wrong and it costing them money. But Amazon was also one that I really liked. I really liked this push through to new lows that snapped right back on March 18th. I thought that in conjunction with the fact that I was expecting the market to bounce up was a real signal to buy the stock. I really liked this tail down here. So I was trading it long and buying it basically several trading sessions in a row. Again, I don't have it right now. This is another one. If you're flat the stock, I would not be buying it here at 202.50. If you are long from these lower price levels, I would book some profit, honestly, into this declining 21 EMA, which is more or less where we're trading right now. But I would also look to hold a percentage of my position for a further move. I think a bounce back to 205 to 210 is very, very possible in Amazon if we get a little bit further of the market continuation. But I'm just going to say, very, very broadly speaking, whether it's me looking at the market, the SPYs, the Qs, or me looking at Amazon or a lot of names that are similar to Amazon right now, I do like the idea of being greedy and pushing for some further upside continuation to make more money on really good longs that you already put on. But this is not the area where I would be aggressive in putting on new longs right now. We have bounced back from SPY 550 to basically 575 because there was an ex-dividend in there in a very short period of time. It's been a $25 bounce back into a declining 21 EMA, which is what I consider to be the upper band of technical equilibrium. Textbook trading wise, for any counter trend trading that you did in buys back down here, this is where you want to be booking profit. This is not where you want to be putting on new long exposure. I like the idea of booking profit in the market, of booking profit in Amazon here, but I'm not saying get out 100% because I really do think that there is a strong possibility that we overshoot to SPY 580, and you want to make sure that you get the most bang for your buck on the risk that you had put on those swing trades initially.
All right, good stuff. All right, this is not as exciting of a week as last week when it comes to economic data. We had the Fed decision last week, but we're coming off that Fed decision into some important data this week. We get the the second revision of Q4 GDP on Thursday. We'll get the PCE price index on Friday. That's definitely the focus, I think, of the week is that PCE price index post-Fed to see, that's their favorite inflation gauge. Anything, do you think we'll get any kind of good read on longer term market feel about the Fed and inflation out of any of these numbers this week, or is it just meh?
So the PCE is important because the Fed always says that that's what they like to pay attention to the most, though we always see that the market doesn't move as much on PCE as it does on CPI for whatever reason. So I do think that these numbers are important. And because we're in an environment where gamma is pretty flat and liquidity is pretty low, it doesn't take a lot to give big movements from the market. So I do think that all these numbers that we have this week, GDP, PCE, some housing numbers, will be market moving, but I don't think that any of these numbers either are going to be like these, make or break numbers where we look back in May and be like, oh my gosh, do you remember when the revised GDP number came out in that last week of March? No one's going to really care 2 months from now, but at least in the short run, as those numbers hit, especially in a market that's got lower liquidity, we should see some actual movement occur, and that can be tradable.
All right. So we're getting the follow through on the long side that you were expecting and hoping for. Okay, hold on. I got a good question here. So popped in right as I was going to ask you kind of a closing question, but we'll go to here first and then we'll go to me. Steven from YouTube asked, Derrick, when looking for consistent account growth, how are you sizing trades? Is it risking 0.5% of the account a good way to size trades? What would be the upper limit of risk relative to account size?
Sure. So the first thing I would say is that you need to take into account your own goals, your own, personal system in terms of your account size and how much money you have that is outside of your account and things like that when you're coming up with these numbers. And I do think to some degree, it's a very individual thing. Very, very broadly speaking, to the professional prop traders that I have in my team, and then again, everyone should break it down to their own individual unique circumstances. I don't like the idea, I'll start with a full day's worth of risk. I don't like the idea of anyone risking more than 5% of their account in any given day. That would encompass any and all trades that you take in a given day. So if you want to start at that 5% number, you then break it down from there. That means that if you wanted to risk 1% in every trade that you take, that you could take potentially up to 5 trades per day. But I don't think that the right way to trade is with uniform risk. Actually, let me take a half step back. I'll give you an even better, more appropriate answer. I think that where you are in your career should determine whether you're taking uniform risk on every trade that you take or whether you are implementing what I call risk skew. For people who are very, very new traders, complete entry level, I like the idea of doing exactly everything uniform. So you risk your 0.5% or 1% on every single trade that you take. And that way you're not focused on anything except the actual trade mechanics. You know exactly how much you're supposed to risk in every trade. So it's one less thought process that you have to go through when you are deciding whether or not you have to put on a trade. Because if you think about it, there's so many things that you actually have to think about when you're putting on a trade. Is this a good trade? What is the trade? Why am I getting in it? Where is my stop loss if I'm wrong? Based on where my stop loss is if I'm wrong, how much tier size should I be taking on that trade in order to risk X amount of dollars, which is the equivalent of that 1% of my account. So the fewer decisions that you can make as a new trader, probably the better, because it enables you to focus more on the trading mechanics and the learning process. After you've probably got, let's say, at least 1 year worth of experience, and this is also going to depend on the trader, but let's say at least 1 year's worth of experience, then you want to begin to implement, maybe even 6 months, you want to begin to implement what I call risk skew. Risk skew is, I think, an extremely important technique for anybody who is a little bit more seasoned of a trader to maximize P&L. Risk skew is the idea of risking more in better trades and risking less in worse trades. Obviously, you're never going to take a trade that doesn't have a positive overall expectancy, meaning the risk reward and probability of success of that trade as you perceive it on any trade that you take should be a positive number, even if some trades will fail, because otherwise the trade's not worth getting into. But there are trades that will have a better risk reward and a higher probability of success than other trades, even if those other not as good trades could make you money if you took them 100 out of 100 times. And the idea of risking more on a better high risk, high reward, better risk reward multiple, better probability of success trade versus lower is called risk skew. And that's when you begin to build in a grading system on your trades. So this is an A+ trade. All the stars are aligning. It's got everything I could possibly want on the side of the trade. The stock is relatively strong. I'm going long. The market's on my side. It got upgraded this morning, so it's in play. It's a great time of the day to be executing this trade, which typically means it's happening in the morning. There was beautiful large institutional option flow that was bullish that was coming in on the stock. You've got all the stars aligning on this trade, and the entry versus stop loss also means that it's a really good risk reward. That's an example of like an A+ trade. Or maybe you have like a C level trade, which is a trade where, again, if you take that trade 100 times, you're going to make money at the end of 100 times. But there's some things that are on the side of the trade. There's some things that are against the trade. It doesn't have quite as good of a risk reward. So therefore, it's not as good of a trade, but it's still worth taking. You should be risking more in the A+ trade and less in the C trade. And that's what risk skew is. So circling back to, I want to risk 5% of my account in any given day. Well, maybe on a genuine A+ trade, you want to risk the entire 5% on that one trade, because that happens so rarely and that risk reward is so greatly in your favor. Still not 100%. Any and all trades, if you trade long enough, I promise, will fail. You could press the button on that A+ buy setup, and then next thing you know, a new headline comes out for that company, or comes out for the economy, or comes out for the market that causes the entire market to crash, and you get stopped out of that A+ trade, and maybe you lose that 5% of your account all in that one trade. But you have to look back at it still after the fact and say, you know what? It was worth it for me to take that, and I just got, hurt because this news came out that I wasn't expecting. And then maybe a C trade is a trade that you want to risk 0.5% of your account on. So you could take 10 C trades over the course of an individual a day. So that is the concept of risk skew, and that will pay you better or worse over time.
Good stuff, Derrick. That's the kind of stuff we like here. Helping people from a professional standpoint on, the risk and reward and all of that. And it's definitely good stuff. All right. I want to ask you for your ideas of the week, your favorite setups. What are you looking at on? It's Monday. You have the rest of today and 4 more trading days to go. So what are the favorite setups for you this week? I'll put your
Sure. So unfortunately, the degree of the gap this morning, I think, is taking away a lot of new opportunity right now. If someone wants to be super aggressive, they could already be really trying to work back into the short side of this market here as we get into the declining 21 EMA. I'm trying to be more patient right now on that. So for me, in this zone, there's just not much that I'm in love with. And for me right now, everything is starting from the market before it goes down to any individual stocks. Just because the market movements have been so big. It's all about market first, pick your stock second. I can't tell you how many times, even on day trades over the course of the last couple of weeks, I see something in the market that I like for a buy, and I'm almost just randomly pressing the buy button on Amazon or Nvidia or something like that to trade it that I think will move with the market when I'm actually liking the market. So first and foremost, it's the market. I really hope that everybody's been listening to me over the course of the last couple of weeks, in which case they're just in a great spot here this morning, and it's a great spot just to be booking profit. The number one thing I like right now more than anything is booking profit on longs that you already have. That's my favorite trade, is you already took a trade and you're getting paid for the hard work that you already did. As far as things that are new, I don't like this spot right here for things that are new. So the market now, we had this breakaway gap above 570. 570 is really important. Again, we had next dividend, so it's really more like 568 for the SPYs that they need to hold. And the Qs, I think, are going to be ex-dividend this week. But right now, 485, really, really important that we continue to hold. If we lose those levels, then it's showing us that we're actually getting a false breakout here on these timeframes, and then we need to reassess everything. The other place where we need to reassess everything is if we really get that upside overshoot. If we really get that move up to 580, if we really get that move up to QQQ, 495, 500. And again, at that point, that's where I may look to get more aggressive in the Teslas and Palantirs and MSTRs of the world on the short side. But I want to see the whites of its eyes. I want to see us get to those price levels before I really begin to initiate those new positions. So for me today, I have done nothing new at these prices. It has been 100% about managing the swing positions that I already had on, and honestly, getting paid for having done a really good job on those positions at the right time.
All right. Hey, professionals know when it is not the time to add new trades, but just to manage the trades you came into with. Was it scary for you? Okay, so you didn't add anything new, but you had 24 longs today. Was it scary for you to go home with 24 longs on a Friday over a weekend with the way things happen in this market, or you felt comfortable?
I was pretty confident and comfortable. I really liked Friday's price action, the way that we gapped down and got supported and closed on highs. And I don't remember what it was, but there was at least one negative headline that came out throughout the day on Friday that the market just completely ignored. So for me, whenever I see like negative headlines come out that don't move the market lower, that's a real signal for me for the other side. So considering that I already endured, kind of what I endured by starting a little bit too early on the long side and having to endure with those new lows at close on Friday, I'm pretty nicely in the money on the vast majority of the swings that I have on at that point. I'm pretty happy with where I'm at, and I just want to see what we can do on Monday. So I actually had one of the least stressful weekends or overnights, I feel like, over this weekend than I've had at any point since this market broke down. And that was even with me being short through most of the breakdown. So yeah, no, it was good. It was a great weekend. I got some great skiing in this weekend, some great powder this weekend. It was awesome.
All right, and you came into Monday refreshed and ready to book the profits that you were expecting. All right, I'm gonna let you get back to trading. Derrick is a real trader. He is the lead trader for T3 Trading Group. If you like anything he said here today and you want to possibly work with Derrick, you can go to t3live.com/DOLive to get his free ebook on prop trading. And within that, you can learn how you can work with Derrick himself and the other prop traders there with T3 Trading Group and the ProDesk virtual trading floor. All right, so again, Derrick, good luck on the rest of your day today, the rest of your week, and I'll see you here next Monday. Bye.
Thanks, Retta.